There's a version of wealth that is designed entirely to be seen, and there is a version of wealth that is designed entirely to grow. And for most of your life, the financial system around you has been very good at making sure you cannot easily tell the difference between the two. The cars in certain driveways, the vacations on certain feeds, the watches on certain wrists, none of these things tell you what someone's net worth actually is, and yet the human brain, wired for social comparison and status recognition, processes these signals as evidence of financial success. This is not an accident. It is the predictable outcome of a consumer economy that profits when people spend to signal rather than save to build. And understanding that dynamic is the first step toward not being trapped inside it yourself. The concept of fake rich is not about judging how people spend their money. It is about understanding a very specific financial psychology, the psychology of someone who has prioritized the appearance of wealth over the construction of it, often at significant cost to their long-term financial position. Economists and behavioral researchers have studied this pattern for decades, and what they consistently find is that the behaviors associated with visible wealth and the behaviors associated with actual wealth building are frequently in direct opposition to each other. The person who looks the wealthiest in a given room is statistically, more often than not the wealthiest person in that room. Sign 1. Their income is high, but their savings rate is near zero. One of the clearest early indicators of fake wealth is a high income paired with virtually no savings accumulation. This pattern is remarkably common across income brackets, and it tends to intensify as income rises because lifestyle expansion almost always tracks income growth in people who are optimizing for appearance rather than security. A household earning $200,000 a year with no meaningful investment portfolio and 3 months of expenses saved is, financially speaking, far more fragile than a household earning $60,000 a year with a disciplined savings rate and compounding assets. Income is not wealth. Income is a flow. Wealth is a stock. And someone who confuses the two will spend their entire career generating money that passes through their hands rather than accumulating beneath them. There is a specific pattern visible in fake rich spending, where social expenditure, dinners, bottles, trips, events, is consistently disproportionate to underlying income and savings. This happens because social spending is the most visible category of consumption, and for someone motivated by status perception, visible spending carries the highest psychological return. The behavioral economics term for this is conspicuous consumption, a concept first formalized by Thorstein Veblen in the late 19th century. And the core insight is that certain goods and experiences are purchased not for their utility, but for their communicative function. They exist to send a message about the buyer's position. The problem is that this form of spending compounds in the wrong direction, eroding capital that could have been deployed into assets. Pay close attention to how someone discusses money. People who have built genuine, compounding wealth tend to talk about systems, allocation strategies, asset class behavior, rebalancing approaches, tax efficiency, long time horizons. People who are performing wealth tend to talk about transactions, what they paid for something, what something is worth, what they plan to buy next. This distinction is subtle but consistent. Someone deeply embedded in real wealth building has internalized that the interesting part of money is not the spending of it, but the behavior of it over time, and their conversation reflects that orientation. Someone performing wealth is, consciously or unconsciously, narrating their consumption for an audience, and the content of that narration is almost always about things rather than systems. A highly diagnostic question to ask, not out loud but as an observer, is whether a person's financial decisions seem to be optimized for external visibility or internal compounding. Would they make the same purchase if no one would ever know about it? Would they choose the same vacation, the same neighborhood, the same watch?
For people building real wealth, the answer is often yes, because the utility they derive from a financial decision is not contingent on social observation. For people performing wealth, the social observation is frequently the primary utility, and without it, the decision loses most of its appeal. This is a psychological orientation that tends to be deeply embedded, and it produces a consistent pattern of spending that prioritizes the signal over the substance.
Net worth is not income. Net worth is not possessions. Net worth is assets minus liabilities, and assets that actually build wealth are things like equity positions, income-producing real estate, business ownership, and compounding investment accounts. Someone who earns well but holds most of their wealth in depreciating possessions, cars, clothing, electronics, furniture, has a net worth that is considerably lower than their lifestyle suggests, and often lower than people at a fraction of their income who have been quietly allocating capital into appreciating assets for years. The genuinely wealthy tend to have portfolios. They tend to have ownership stakes in things that grow. The fake rich tend to have collections of things that lose value. Financial resilience, the ability to absorb unexpected shocks without catastrophic disruption, is one of the most honest measures of actual financial health, and it is almost entirely invisible from the outside. A household with a high income, an expensive home, luxury vehicles, and frequent travel may have virtually no buffer against a job loss, a medical event, or an economic contraction. The absence of liquid reserves and the presence of high fixed obligations means that the entire structure depends on income continuity, and when that continuity breaks, the lifestyle collapses rapidly. This fragility is one of the defining characteristics of fake-rich financial architecture. It is optimized for normal conditions and extremely vulnerable to disruption, which is precisely the opposite of what genuine wealth is designed to do. This is one of the more nuanced signs, but it is worth examining carefully. There is a meaningful difference between generosity that is structural, recurring giving, systematic support, quietly sustained, and generosity that is performative, meaning it is concentrated in visible social moments where the act of giving can be observed and credited. Neither form is inherently wrong, but the pattern of someone who is very generous in public settings and noticeably absent from private, sustained commitments often reflects the same underlying psychology as the rest of the fake-rich profile. The value of the action is located in its visibility, not in its impact or its consistency. Perhaps the deepest and most consequential sign of fake-rich psychology is the orientation toward external comparison as the primary metric of financial success. Someone who measures their financial position primarily by how it looks relative to their peers, their neighborhood, or their social feed is operating on a system that has no natural ceiling and no stable equilibrium, because comparison is a moving target that expands as fast as you approach it. Genuine wealth builders tend to measure success by progress toward defined personal goals, a specific portfolio size, a retirement date, a passive income threshold, a debt-free balance sheet. These are internal metrics, and they produce a fundamentally different financial behavior pattern than the comparison-driven approach, which tends to generate spending pressure every time someone in your reference group visibly upgrades. Understanding these 10 patterns is not about judgment. It is about clarity. Clarity about what the signals around you actually mean, and clarity about which direction your own financial decisions are pointing. The economy produces an enormous amount of noise designed to make consumption look like success, and learning to see through that noise is one of the most valuable cognitive tools a person can develop. Real wealth is quiet, structural, compounding, and largely invisible. The loudest version of money in the room is rarely the most financially secure version of money in the room, and the sooner that distinction becomes instinctive, the more clearly you will be able to navigate the financial decisions in front of you.